Hello and welcome back. Today we'll be taking a look at a new ETF. Its ticker symbol is TXF and it's called the CI Tech Giants Covered Call ETF. The CI in the name refers to the asset management company that manages this ETF, and you can probably tell from the name that it is a tech related ETF, so it mainly does contain tech companies. But more importantly, it is giving out a yield of almost 9% annually. Now, you probably know that a lot of tech companies are mainly growth companies, so they do not pay out any dividend. But using covered call strategy, this ETF is able to generate income. And at the same time, the strategy that this ETF uses is also able to give you some participation in the growth of those ETFs. So, one way to look at this ETF is that it is a very good combination of income and growth. So, in this review, I will go over its holdings, what is the strategy the firm uses to generate this income, and we will also look at its track record. It is a pretty old ETF, almost 10 years old. So, we do have a good amount of track record to see how well their strategy has worked in the past decade. All right, so without any further delay, let's get started. All right, so these are the holdings of this ETF. And as you scroll through the list, you will find mostly big names within the tech industry: KLA Corp, Synopsys, AMD, Nvidia, Apple. So, mostly names that you're probably familiar with. And if you really look at the sector allocation for all these companies, they are either computer electronics or information technology. So, mainly it's either a company that is providing the software or a company that is providing the hardware or the equipments on which the software runs. So those are the mainly two sectors that this ETF covers. And as far as weightage given to each stock is concerned, if we look on the right hand side, we see that all stocks weigh around 4% more or less. In total, this ETF contains 25 stocks, so each stock is given an equal weightage of approximately 4%. It is important to note that the holdings we see on the screen are not set in stone. The fund aims to actually hold the top 25 companies by market cap. So, on a quarterly basis, they do in fact rebalance the portfolio to account for the changes in market caps of the companies. So, one way to look at this is that this ETF functions almost like an index fund that is tracking the top 25 tech companies in the market. But obviously, it also has that added advantage of a covered call strategy that generates income. So, now let us take a look at how the strategy for this ETF works. So, if you click on this link called Positioning Piece on their website, it will open a PDF document that looks like this. So, this document mainly highlights the overall strategy that they use for writing covered calls. And if you scroll down, you will find it mentioned in just the second paragraph. So, right here, they are writing monthly at the money call options on approximately 25% of the portfolio. So, let's just break that down. So, monthly obviously implies that the option will expire within a month. At the money means that the option is being written on the current market price. So, whatever is the current market price at the start of the month, they write the option at that price. And this third part is really important, 25%. So they're writing the option on only 25% of their holdings. What that means is that we can still get capital gain from the remaining 75% of the holdings. Because remember, everyone, when you're writing covered calls, you are sort of limiting the upside potential of the stock. But in this case, since the covered call is written on only 25% of the holdings, which means the upside potential is still there for the remaining 75%. And in fact, if you scroll down further, over here they even give you an example of how this strategy works. So all the stocks that they hold are held in bundles of 400 shares, and they issue or they write covered calls on 100 of those shares, and for the remaining 300 shares you're able to receive the capital gains, or maybe even a capital loss for that matter, depending on how the stock actually performs. All right, now that we know how this ETF works, what is its strategy, let us take a look at how this ETF has performed over the past decade. As I mentioned earlier in the video, this ETF has been in the market for a considerable amount of time. So we have a really good track record to see if it has actually performed as expected. So I'm just going to go ahead and click on the max button over here, which gives us its price movement since its inception, since the time it started trading on the market. So it started trading all the way back in October 28, 2011. And if you look at it, it has had sort of this linear growth since that time. In fact, at its highest point, it was up 123% over a 10 years period. Remember, this is just a capital gain. It does not include the additional 9% annual covered call income that this ETF gives out. So, this is one of those rare ETFs which is giving us both income and capital gains. And obviously, its recent sort of a downturn that we can see is very much in line with the tech industry as a whole. So since 2021, it has gone down almost 25%, which should not really surprise anyone. If you have been in touch with how the markets have been and how the tech industry has taken sort of the biggest hit of all the recent things that are going on in the market. But I'm personally very bullish on the tech industry in the long term. So I really find this ETF as a very good investment based on how it has performed over the past almost 12 years. One thing we must all keep in mind about this ETF is the fact that it is very much concentrated on a single sector, which is the tech sector. And even within that, it is only tracking the top 25 companies within just US. So, in terms of diversity, it is not exactly a very diversified ETF. And that is part of the reason why we are also getting all that capital gains, despite the fact that it is a covered call ETF. So, there are some trade offs with this ETF, but the way I see it, this could easily become part of a diversified portfolio where this ETF focuses on the tech sector, and then there are other ETFs and stocks which focus on other sectors or even other geographic locations to provide the overall diversity to the portfolio. But overall, given its track record, given the fact that it is giving out almost a 9% yield, and then there is the probability of capital gains, I would say this is not a bad ETF to invest in. But as always, do your own research before making any investment decisions. If you like this video and found some value out of it, don't forget to like, share, and subscribe. Do check out my channel for other similar ETFs. See you guys in the next one.